Silver futures dip sharply on MCX. Silver ETFs take a sharper beating, down anywhere between 10 to 25% on likely liquidation of leveraged positions and low liquidity.
Dr. Reddy's top Nifty gainer after it delivers a beat in the third quarter. India, Europe, emerging markets, all of them lead growth. Margins come in at around 23%. That compares with expectations of around 21%. The management tells CNBC-TV18 they expect single-digit growth in the United States, while other markets are expected to grow in double digits. The stock bursting away, up 5%.
PNB Housing languishing in an otherwise strong market. The stock down 7.5% on the back of a weak set of earnings, which missed expectations on most counts. Loan growth comes in much lower than management's guidance. Disbursements, margins too lackluster.
Earnings strength pulls up shares of Bajaj Consumer and Vari Energies. Bajaj Consumer delivers a solid 83% growth in the profits. Record quarterly module production as well as strong order pipeline aids the growth for Vari Energies.
EPAC prefag downbeat following a 25% sequential dip in revenues in the December quarter, which is seasonally strong. This even as the order book for the company grows over 30%. Management tells CNBC-TV18 they expect revenues of around 1,500 crore rupees in FY26. The stock down by 10%.
Well, hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam. And it's been so long that we have seen some kind of green on the screen. You know, at least it's in the green, Mangalam. It's come off 100 points from the top, but we'll take the positive. There is some green on the screen.
Yeah,
so good
clutch at the positives, Nigel. It is a positive, and the market breadth is looking a lot better than what it was same time yesterday. Though there was a recovery from yesterday that did not sustain at the highs, and today's opening also hasn't sustained at highs. But the good part is that the market's made a firm base for itself. Those two lines, that tell you the story of the day. From the word go, they have been maintaining that distance between each other, and maybe this train tracks continue in today's trading session as well.
I thought you were going to sing a few lines of the song.
No, Nigel. Maybe if it sustains and goes at goes to the high point of trade, maybe we'll sing
only the first line. After that, it'll be a little issue.
All right, what do? Let's get you some ideas for profit in the meanwhile. Let's get some ideas from our colleagues at Money Control Pro as well. Anubhav Sahu of moneycontrol.com joins in to talk about the stock that he's been tracking. But before we go to Anubhav, the other big Money Control exclusive yesterday of Donald Trump saying to India that maybe there will be a good deal soon has led the markets higher as well. We'll take that. We'll take credit for that as well from our Money Control guys. Anubhav.
Well, talking about Syngene, which is the leading CRDMO player in India, while it has been impacted by inventory adjustment by its key client Zoetis in last few quarters, we believe they are offsetting growth levers around. Now, firstly, a passage of USA Biosecure Act opens up opportunities for Indian CRDMO companies, and we expect that in next 12 to 18 months, there would be strong pickup in inquiries from the biotech firms. Secondly, Syngene has forayed into clinical trials opportunity, which is amongst the biggest sub-segment in terms of market size. Now, in this context, Syngene secured a global phase 3 clinical trial from a USA-based biotech company to start with. Then some of the new biologics facilities are on the verge of becoming available. Now, Unit 3 facility is partially operational. Going forward, management expects this facility to contribute to the bottom line by fiscal year 27. Similarly, Bayview Biologics facility is likely to be operationalized in current quarter. Now, in addition, our company is building a new bioconjugation suite in Bangalore to target manufacturing of antibody drug conjugates. Lastly, valuation is at a significant discount to the peers. At the same time, one should note that last 4 years, gross block has gone up nearly 50%, and some of the facilities should start contributing to the bottom line in the near term.
All right, good time to get in Sachidanand to take her on the market technicals right now. Sachi, we've recovered a fair bit from yesterday's lows. We opened well also, but holding on to the green though off the highs. What should one do? Is it a no-trade zone? Are you waiting for some specific levels for either direction calls?
Good morning, Mangalam. Mangalam, I think yesterday's verdict was very significant. We saw a very strong recovery, and the Nifty again, managed to, give a close above its 200-day exponential moving average support, which is placed somewhere close to around 25,150, 140 thereabout. So I think an occurrence of a spinning top kind of formation near this particular support is a very significant development. But as we see, candlesticks always require a validity in terms of a consecutive closing. So I think going forward, we may see this volatility for next couple of trading sessions. But I think from a trading perspective, now the trend seems to be changing. It's a buy on decline scenario which we are observing. In fact, 25,240, 220 is an ideal zone wherein some long positions can be committed when it comes to Nifty. One can keep a stop loss at 25,160 on closing basis. And during this particular week, or probably in next couple of trading sessions, we may see again Nifty, rebounding towards 25,525 to 25,700.
Okay, all right. There's a possibility that Nifty does see a bigger rebound. Sachin, I missed the stop loss.
Good morning, Nigel. Nigel, I think the level at 25,160 is now very significant. We need a firm closing below this particular level just to, invalidate this particular trade. So I think the stop loss can be placed at 25,160 on closing basis.
Got it. Individual stocks you want to help us out with?
Nigel, I think since yesterday, what we have seen is a good development in some of the pharma stocks. And if you look at the structure of Lupin, which has been very significant, we have already seen very strong relative outperformance. Despite of the volatility in the market, the stock was sustaining above its 5-week exponential moving average support. Now, if you look at the overall data set, it looks like a bullish flag formation in process, and we may see a move towards 2220 on an immediate basis. But if you look at the overall pattern structure, it is indicating a price target somewhere close to around 2280. Hence, we are recommending building fresh long positions in Lupin, keeping a stop loss at 2162 on closing basis. The other stock which has come on our radar is REC Limited. Now, it's a very significant development wherein the stock was in a lower top, low bottom sequence since last 11 months. Now, if you look at the recent development, it has already breached from a declining wedge formation, and the recent consolidation now looks like a bullish pennant on the daily scale. So we are expecting a good rebound in this particular counter, and probably we may see the stock again scaling towards its 200-day exponential moving average, which is placed at around 386. And hence, we are recommending building long positions on decline. One can keep a stop loss at around 358 on closing basis and accumulate the stock for 386 targets.
All right, take that point, Sachi. Thank you so much for that. Your individual stock calls as well as your call on the markets. What we'll do is take a short break, come back on the other side. We have the management of EPAC Durables trading with gains after reporting a steady set of the third quarter numbers. We'll speak to them about the RAC business and the others after this short break. Ajay Singhania joins in. The Nifty holding on with gains of almost 135 points. Look at Bajaj Consumer, 16% higher right now. To my mind, the consumer result of the season so far, 31% revenue growth, 80% plus growth in the profitability, EBITDA doubling, margins improving by over 800 basis points as well. All things in the right direction with the company having valuation comfort as well. That stock continues to surge. But the other one on our radar is consumer durables company EPAC Durable. A decent set of third quarter earnings, largely aided by their small and large domestic appliances and component segment, not so much by the room AC segment, and which is why perhaps the stock has moved off the highs as well. Ajay Singhania joins us now, the CEO of the company. Obviously, we will be discussing the room AC down cycle, whether it's a temporary blip, revenue mix changes from non-room AC business, and revenue as well as the margin guidance for FY26. Let's start with the room AC part of the business, sir. That one saw a bit of a dip while we saw good performance coming in from both large and small domestic appliances. Could you give us a sense on whether this is likely to recover? This is temporary in nature because of the inventory that everyone's sitting on right now because of the weather conditions. What's your growth guidance for the room AC segment over the next couple of quarters? And how does this revenue mix change over the next couple of years?
So good morning. With regards to the room AC industry, we all know that the previous 2 quarters, Q1 and Q2, were highly subdued, and because of the unseasonal rains, there was a huge amount of inventory lying in the trade. Thankfully, after the GST reduction, some bit of movement has started. And then Q3, definitely we saw a huge amount of dumping by the brands in terms of the primary sale, although the October, November, December quarter not being a sales dominant season, but still because of the BE change, the inventories were dumped by the brands to the trade. So currently the trade inventory is slightly elevated. But at the same time, looking at the upcoming season, everybody is very bullish that with a strong set of summer, definitely in the entire industry is going to witness a good summer and recovery from what we have witnessed last year. So AC continues. I mean, despite the headwinds in the last year, the strong tailwind still continues. So the long-term story still remains that the industry is poised on 15 to 20% kind of growth over next 5 to 10 years for sure. So AC is still strong. The industry degrew over the last 9 months, and the same is what is reflected in the numbers of IPAC Durable as well. So for us, the shift from AC to the large domestic and small domestic appliances is a strategic shift. And this is something we have been focusing largely so that we could balance the seasonality in AC and also improve our overall asset turn.
Right. So, Mr. Singhania, you believe that demand will come back, right? Setting you up for a good summer.
Absolutely. So the industry is planning somewhere at 15 to 20% kind of an increase over the financial year 24-25 numbers.
Got it. All right. So let's hope that comes to that. But what about your growth outlook? And I think at the start of this year, the indications were you want to grow at around 35% with margins of around 7.5%. Yes. Now, that's not happened in the first 9 months. Realistically, what do you end the year with in terms of a growth number, if at all? Will it be a flattish number? And given that you're optimistic that demand comes back, very carefully, I would request you to tell us for FY27, what could your growth estimates be, sir?
Okay. So first of all, coming to FY26, so since 9 months already passed on, currently we are looking at almost like a flattish to a marginal growth in revenue, despite the degrowth in AC. So the degrowth in AC could be anywhere between 10 to 15%. So that degrowth has largely been set off by the increase in our small domestic and large domestic appliances, and that both the new diversification products will continue to grow at a much higher rate. Having said that, on margin side, we continue that 7.5 to 8% kind of margin is a stable margin which the company will deliver and further improve upon in a medium to long term basis. So on a medium to long term basis, we intend to keep our AC portfolio anywhere between 55 to 60% of the total contribution, the total revenue, and grow the other two, the small domestic appliances, large domestic appliances and components at a much faster rate. So that's the overall strategy we have in place to balance the seasonality and to improve the asset turn.
Right. And between SDA and LDA, what is more margin accretive for you? What is the mix that is likely to be there?
So between the SD, LD, both some small and domestic appliances again have a very distinct season. So large domestic appliances for us is coolers, and then mainly now they're focusing heavily on the washing machine, which is kind of a Q3 product. So that's a product which goes in July, August, September, and then comes the Diwali season where the small domestic appliances picks up. So overall, we are looking at balancing the each quarter by having the right set of products, and margins per se are not very different. It's only at the gross margin level we see in both the categories, small domestic and large domestic appliances, comparatively better than AC.
Right. What about components and maybe, further capacity additions? At what utilization are you? What's the headroom for growth out here? And the components business, I suppose, could be a margin additive as well, right?
Absolutely, absolutely. So components are much better business to do, although the revenue prospects are less, but then, because it's a small ticket size product, so the margins are comparatively much better even as compared to the small domestic and large domestic appliances. So component is where we have grown multifold in last 2 quarters, and we will continue this growth. We see that we'll continue this growth in component business going forward.
Right. So if we ask you, say, FY27, you presumably grow around 20%, given the AC industry growing at around 15%, that's what you're expecting. And then you have other components which will grow a lot faster. 20% would be a lot more realistic, right? Over a flattish FY26, what does your revenue mix look like in FY27, and what kind of margin should we expect then?
So like I shared earlier, in medium to short term, we are looking to maintain a 55 to 60% of contribution coming from room ACs. and almost 20% from components and another 20% from small and large domestic appliances.
And margins by the end of FY27 would be what, 7.5% to 9% itself?
Yeah, 8%, around 8% plus minus 0.25 is an average guidance. We believe that definitely will
take that point. Thank you so much for joining in and giving us your outlook. Wish you good luck and perhaps a good summer for your business. A good summer for your business, not necessarily a good summer for our experience, but be that as it may, that's the nature of life.
We want to keep the comfortable season and then improve the comfort of everybody.
Take that point. Thank you so much for joining in. We take a short break, come back on the markets and a lot of stock-specific action. Stay with us.
It's still green on the screen, but we've slipped considerably from the highs of the day. Currently, markets holding at around 25,270. The good news is the breadth of the market is still firmly in favor of the number of stocks advancing. It's been a while since I said something like that. Well, let's go across to Gaurav. He's here to tell us about PNB Housing, which is under pressure post the week showing in quarter 3 numbers. Gaurav, tell us more.
If you look at PNB Housing, first let's go through the numbers, what they have reported. Net interest income that increased by 10%, while PPOP increased by 8% because there was some pressure from the OPEX that we saw because of the employee costs that increased in this quarter, and at the same time profits that increased by 8%. It was a bit lower than the street's expectation, but let's also go through some of the factors why the stock is down. There are 3 key reasons. First is that let's talk about the loan growth number. Now loan growth came in at around 14%, and in fact within that, if you look at retail growth, that came at just 16%. Remember, management was guiding for 17 to 18% of the retail growth. Although they have maintained their guidance, that was the first strike. Second is that if you look at net interest margins, now they have declined almost by 4 basis points, although it is still in that guided range of 3.6 to 3.7%. This quarter, street was not expecting net interest margins to decline. Management said that there will be some pressure going ahead as well in the likes of 10 to 12 basis points in terms of yield on advances, and that is the reason why, although they have maintained the guidance, there was some bearish comment there as well. Other than that, they are saying that if you look at the disbursement growth, now that came in at around 15.6% on a year-on-year basis. This was the biggest disappointment, and the reason being, if you look at the disbursement specifically in the affordable segment, that came down almost by 15%. This was a negative surprise for the market because given that the company is actually focusing more on the affordable segment, in fact, they also said that the affordable segment is going to get impacted. Not going ahead, but in this quarter specifically, it was impacted because of the Tamil Nadu issue and the governance issue that we have seen from that region. Going ahead, they are confident on bringing back that growth. In fact, they're also saying that this portfolio will be 40 to 45% of their overall portfolio versus what it is right now at 39%. There are some concerns around ROAs as well. Now, going ahead, management says that ROA is going to be in the range of 2.6 to 2.7%, but 3 key points. First is net interest margins, where they are seeing some kind of pressure. Second is that some kind of setback that we have seen from the affordable housing segment. And third is the credit cost. Now, in this quarter, in fact, in this year, they're expecting credit cost to remain negative, but in FY27, it will come back to the normalized level of 20 basis points. And the street is concerned that to achieve that stabilized ROA of 2.6 to 2.7%, there are many levers that the company will have to move. And that is the reason, if you look at the stock performance, it is currently under pressure.
All right, Gaurav, thanks a lot for that. From a stock which is under pressure to a stock which is at the day's high right now. Bajaj Consumer opened 7% higher, kept moving higher, and now as we speak around 16.5% in terms of gains that we're seeing, closer to 16%. Why is that? A stellar set of numbers coming in across all parameters. It is a beat. Why do I say that? Because there was a visible change under the new leadership. Naveen Pandey took over the company a couple of quarters ago. And now the revenues have grown, 31%, 234 crores turning into 306 crores. The EBITDA has more than doubled from 26 crores all the way up to 56 crores, which means that the margins from 11% have also gone all the way up to 18%. The management's guided for it to be around that 20% mark. So there is still some more headroom for margin growth here. The net profit obviously has also, on the back of that, surged from 25 crores to 46 crores. If you look at the internals, a large part of their business, most of their business actually comes in from almond drop hair oils. And if you look at the low unit packs, the sachets, etc., they've done extremely well, perhaps post the GST cut that has happened, which tells you that, demand at the bottom end is reviving a lot faster than the demand at the premium end. And that is volume accretive for the FMCG industry. Double-digit volume growth in Almond Drops hair oil, which is the mainstay of the company. And their non-ADHO portfolio, which is a smaller part of the business, that too grew in mid-single digit. And additionally, Bajaj Coconut portfolio has registered high single-digit value growth, which also is a positive because coconut is a fairly competitive market with the likes of Marico, which are the leaders, and Dabur, which are challengers, also looking to gain market share out there. So the new leader is a former Marico man. Let's see how he performs in the coconut business going forward. But for now, the stock before these numbers were trading at 17 times. You would not see an FMCG stock trading at 17 times. It was rightly so because there was no growth. But now as we speak, growth has come by. The street is taking note of that.
I got that, Mangalam. Thanks for that. Well, let's also listen into some market opinion we got from market veteran Sunil Singhania on the current state of the Indian markets. Let's hear him out.
A lot of parameters are starting to show signs of, I would say, scare at the peak. The number of new lows which we hit yesterday was almost 750, 800. It's a good indication. I think 52-week lows after a not so great year, particularly for broader markets, point that a lot of investors are giving up and just throwing up stocks. On the other hand, on the global side, yes, I think this Trump mania has been reaching peak. But now I would say the good thing is that almost all countries have started resisting it. I would say that even on the mid and small cap side, we are at least being a little bit more proactive and trying to see where we can get value in this, really fearful times. We have a budget coming in. The macro parameters are pretty steady and healthy. Balance sheets of corporates are pretty steady and healthy. Obviously, the external environment is such that growth is right now on the corporate profit front stuck at 9-10%. But looking at the scare and looking at the kind of views and news flow coming in, I would stick my neck out and say that, it's time now to start investing. In fact, last 1 week, we have been quite aggressive in investing. And it's not about large cap, mid cap or small cap. It is about stocks where there is visible profit growth and valuations are not out of whack.
All right, good time to look at companies where valuations are not out of whack and there is visibility on profit growth. That's exactly what the street is trying to do as panic sets in. We're holding on to, the level of 25,250 right now, though off highs, still sitting with gains of over 100 points. With that, we wrap up on this edition of Chartbusters. You stay tuned. Trading Hour comes up next.